Hey guys, it's Brian. Welcome to Financial Fitness. If you're new to the channel, please subscribe. In this video, I'm going to talk about how to start investing with $1,000 or less and some of the options that are available. Please do your own research or consult a financial advisor, CPA, and accountant if you need help with your investment portfolio. Let's get right into it. From my experience talking to other millennials, I've come to learn that the most common reason I've encountered for waiting to invest, other than not having any savings, is simply what I call beginner's investment syndrome, which is simply the fear of choosing the wrong investments and therefore not choosing to invest at all. This is similar to when you go to a restaurant, in particular diners, and the menu has everything from breakfast, lunch, dinner, dessert, you name it, it's probably there. There's simply too many choices on the menu, and I think that same idea of too many investment choices causes the same indecisiveness. And to top it off, investments have even more to choose from than a restaurant menu. With investing, it eventually defaults to not making any choices at all, unlike choosing from a restaurant menu. In a couple instances, I've witnessed people even open a brokerage account and deposit money to invest, but just never took the next step to invest the money they deposited in anything for several years. This is not a good mistake to make, and each month and year waiting to invest sets you further and further behind of potentially retiring by age 65 or sooner. When investing long term, which is in many ways the default method and how many people should have some money invested, it matters more that you start investing, period. Now, you can argue that picking a stock or other investments might be tricky if you're new to investing, but just investing in an ETF, exchange traded fund, that tracks an index like the S&P 500 should be just fine, such as VOO or SPY, even if that's the only thing you invest in. When starting to invest, your mindset needs to change away from the fear of not knowing what to invest in and more towards just starting somewhere will help you in the long run. If you have limited investment knowledge and time, consider using a robo-advisor where they can take the stress out of investing for you by making the investment choices, decisions, and managing your portfolio. This takes the emotional part of investing out of the equation, where you can potentially see your portfolio value swinging up or down, or a particular stock, and might make an irrational choice to sell when you shouldn't have. Decisions like those can largely be avoided by using a robo-advisor. When starting to invest, you'll need to figure out two things: how you plan to invest your money and where. Robo-advisors can solve both of those items for you if you choose one with a hands-off type strategy, where they do all the heavy lifting and decision making for you. I'm a big fan of robo-advisors, especially for beginners new to investing. If you want details on some robo-advisors, check out my video on robo-advisors, where I go into detail about the pros and cons of different ones like Wealthfront, Betterment, and Titanvest. The idea behind investing is to let your money work for you behind the scenes for a long period of time and let the stock market grow your money. Robo-advisors will do just that and make any adjustments that your portfolio might need as conditions and variables within the stock market change. Robo-advisors also charge a relatively low management fee in exchange for doing all of the research and work for you and removing the stress of managing your portfolio yourself. If you want to go even lower in cost than the management fees of a robo-advisor, you'll have to look into index investing. Index investing is a low-cost, hands-off, passive, diversified, self-contained approach to investing. Index investing is designed to match the returns of a benchmark index like the S&P 500. Essentially, it invests in everything that's in the index to achieve similar returns and diversification at a cost-efficient price. If you were to invest in each company that was in the S&P 500, it would accumulate into a pretty large amount of money, even if you're buying only one share of everything, because it's also 500 companies. But they're also not all necessarily equal weight either in the index. Some companies will be a bigger or smaller share than others, further making it difficult for you to replicate using your own money to create a similar weighted distribution. Index funds also tend to be more tax efficient than actively managed funds because they make less frequent trades. One of the downsides to index investing is weighting and performance. So if something is weighted heavier within an index such as Amazon or Apple, it could pull the index down a bit. This shouldn't be a large concern, as the stock market does have swings in performance up and down over time, So if you have a long time horizon, it will eventually recover. Some other indexes that are a little bit more focused would be the Russell 2000 and the S&P 400. The Russell 2000 focuses on small cap stocks and the S&P 400 focuses on mid cap stocks. These vary with the sizing of the market capitalization of various companies that are publicly traded. The S&P 500 focuses on large cap stocks that is supposed to be a barometer for overall stock market performance. Some ticker symbols of ETFs that track these three major benchmarks are SPY, VOO, MDY, IVOO, VTWO. You might want to add more money over time and consider dollar cost averaging into additional shares of the ETFs you choose. Keep in mind, if you invest in more than one ETF index, you'll want to rebalance every so often. So say you invested in all three, VOO, IVOO, VTWO. Depending on if the S&P 500 outperforms the Russell 2000, you'll want to set parameters for yourself so you don't have too much of any ETF over the other. I think for beginners new to investing, rebalancing can be the most challenging to figure out what the parameters should be or to know when is the right time to rebalance. This is something that a robo-advisor would handle for you. So if rebalancing is not an activity you want to consider doing on your own, look into using a robo-advisor. In the case of these three indexes, I would consider doing equal weight to make things simple at 33.3% each. If you only want to choose one of the indexes to invest in, index ETFs replicating the S&P 500 would be a safer choice. Robo-advisors and index investing I just mentioned is where I would start for anyone that has never invested before. Index investing and robo-advisors are best for beginners to see what it's like to invest without having to make many choices and being afraid of making the wrong ones. If you're just starting out investing, I do not recommend the next two as they are more hands-on and allow you to customize your portfolio at the expense of slightly more risk and potentially may make your portfolio less diversified. The next two ways to invest are more for people who have already started investing with robo-advisors or index investing and want to expand their portfolio beyond those options. Know that there are additional risks if you choose either of the next two options, and they require you to be more hands-on with your investments. Sector investing or sector ETFs allows for investing in a basket of companies in specific segments of the economy and can help you pursue diversification within your portfolio, growth, and manage risks. There are 11 different sectors within the economy and to invest in: communication services, consumer discretionary, consumer staples, energy, financials, healthcare, industrials, information technology, materials, real estate, and utilities. Fidelity has a nice breakdown of some examples within each sector and their characteristics. With sector investing, you can pick and choose specific sectors you want to invest in over others or in addition to indexes if you choose. Sector ETFs allow you to diversify and weight your portfolio the way you prefer, more so than with index investing. With index investing, it leans towards overall market diversification. There are also pros and cons of each sector, along with different characteristics. Companies within the same sectors tend to perform similarly as well in terms of volatility and general price movement. There are usually some outliers that can either outperform or underperform in any sector in any given year. The main benefits of sector investing are being able to balance diversification with returns that can potentially outperform the overall market. For example, if you believed healthcare would do particularly well over the next couple of years, you could invest in something like XLV, which is a healthcare ETF, and adjust your portfolio accordingly. It can also work against you if it underperforms and your prediction turns out to be wrong. Stock picking is where you choose some of your own stocks to invest in within your portfolio. The main reason people do this is lower to no fees depending on which brokerage firm you use to invest, and people tend to like to invest in companies that they are familiar with. That doesn't make them the best investments necessarily, but people sometimes want to invest in companies that they believe in, even if they don't know much of the financials behind the company. I want to mention some of the benefits of picking your own stocks first before getting into the risks. When investing in stocks, keep this in mind as well. As an example, if you pick stocks and you choose 5, if any one of them becomes a home run and outperforms with crazy returns, it could potentially make up for the other 4 that don't perform as well. I think that's the best way to look at stock picking, whether you are picking for the short term or the long term. This logic does apply. If you stock pick for the short term, you encounter timing issues where you could be in the right stock but buy in at the wrong time. This is less of an issue with long-term investing, where you likely would hold the stock through some drops in price where it should recover over time. Of course, there are inherent risks with doing so as well: business risk, valuation risk, and liquidity risk. Business risk is the potential for loss of value due to competition, mismanagement, and financial insolvency. Think of this as the risks of being in business in the first place. You'll likely have competition in some form. There will be people that manage the business, and financial insolvency comes into play if they have either too much debt or are losing money for too long a time period. With valuation risk, there can come a time where a company can get so far overvalued compared to their earnings and revenue that the stock price has a chance of dropping like a rock. With liquidity risk, you run the risk of needing to sell your investment in a stock if you need money. By not holding the stock long term, you open yourself up to potentially needing the money back for something short term, such as paying taxes or some other type of purchase. When investing, you should have different buckets of money in investments for long term and short-term investments to prevent this from happening. The money that you can't afford to invest with, keep it in your bank account for quick access and don't buy stocks with it. Alternatively, if you only invest long-term, then you likely wouldn't encounter this issue because you wouldn't be needing the money in the near future. With sector investing, you have to rebalance your portfolio more frequently when sectors either grow or decline to keep your portfolio balanced. With stock picking, you have to understand how taxes work on buying and selling stocks, short-term versus long-term, to make tax-efficient choices and do research on each stock you choose to invest in. These 2 options are more for either experienced investors who want to experiment a bit more with different types of investing to expand outside of just index investing or robo-advisors. Try not to do too much of any stock picking or even sector investing without some experience first. If you take the approach of learning by doing, then know that you're doing so at your own risk in addition to the risks I already mentioned. Thanks so much for watching. I hope you liked this video and found it insightful. Click the like button if you did, and please subscribe if you haven't already. Click the notification bell so you can see when I post videos next. Feel free to leave comments, questions, and any topics you might want to hear about in future videos to get on track to being financially fit. See you in the next video.